Hello, everybody. My name is Bennett Tchaikovsky, and welcome to my overview of intermediate accounting. This is for the Wiley 18th edition. This is Chapter 5, Present Value, Part 1. So the information and opinions in this presentation are those of the author only, and not the author's employers or affiliated organizations, including but not limited to Irvine Valley College, the South Orange County Community College District, or California State University at Fullerton. Presentation is for educational purposes only and does not constitute any legal or accounting advice whatsoever. This video is meant to be a companion to the 18th edition of Intermediate Accounting by authors Don Kiso, Jerry Weingett, and Terry Warfield, which is copyright 2022 by Wiley. This presentation is copyright 2008 to 2022 by Bennett Tchaikovsky. All rights are reserved. Any distribution is strictly prohibited. Okay, so for this series, I am not using Wiley's PowerPoint slides. Rather, what I'm trying to go through and do is use sec.gov. But tonight, we're not going to be doing any of that. We're going to be doing some of our own stuff. We're going to be making our own blue magic in the Winnebago. All right. So we're going to be looking at the financial statements of selected publicly traded companies. And I would watch this video prior to going through the walkthroughs that I've previously done. And again, you know, the more you do it, the better off you're going to be. So what we're going to do tonight is we're going to go through some basic present value concepts. And we're going to start by how do we use the present value tables? So it's extremely important because in accounting, a dollar today is not the same as a dollar tomorrow, especially right now in 2022 when the interest rate is only going up, up, and up. So when we have, when we're going through and making, for example, if I am going to be paid an amount, say 2 years from now, and say that amount is going to be $200,000, that is not worth $200,000 today, because theoretically I could invest a smaller amount at that interest rate and it would grow to the $200,000. So this is why when we're dealing with payments, it's going to be really, really important for us to kind of remember in the back of our minds in terms of how this works. Now, one thing I'm just going to stop and share with you really quickly. And one of the things you're going to notice, especially in this chapter, is when you start seeing zero interest bearing notes or things like that, there's just no such thing, right? And in accounting, basically, if there is a zero or a below market rate of interest, we basically has to impute interest. So again, imputed interest, what exactly is it? Well, if something says it's zero interest bearing, that's not really true. So what we're going to go through and do is we're going to say, well, some of the examples we're going to be looking at a little bit later, if a lump sum amount is going to be paid to us in the future and it's zero interest bearing, we're going to have to go through and impute interest on that. So we're going to learn about that in a little bit as well. That's going to be on the second part of this video series, but let's go ahead and get back to our bonds. Okay, so how do we go through and value a bond? And then how do we go through and record interest? And we're going to use the effective interest rate method for the various different dates. So let's go ahead and get to it. Okay. So on 1/1/25, YYZ issues a $9 million bond payable with a stated interest rate of 8%. The term of the bond is for 5 years, and the interest is payable annually on December 31st. The market rate of interest is 10% on the date of issuance. So when I have this bond, and if you haven't looked at bonds payable in a while, it's okay. But if we have a bond, right, what exactly, how does a bond work? Well, this bond is going to basically, it's like an interest-only loan. We're going to have principal. God, I probably spelled that wrong. So we're going to have our principal and we're going to have our interest, right? So over here, the principal amount, so it's like an interest-only loan. At the end of 5 years, it's going to pay us $9 million. And then it's going to pay us, right? So it's like an interest-only loan. It's going to pay us how much? Well, if we look over here, it says that the stated rate of interest is at 8%. So what that means is that every single year, it's going to pay us 8% interest on the amount, and I just made that screw up right there because this is year 0. Okay. So this is 12/31/25, 12/31/26, 12/31/27, 12/31/28, and then we have 12/31/29. The reason why I'm going through and using a bond as an example is for 2 reasons. One, I'm going to teach you about the effective interest method of amortizing a bond discount. And it's just going to serve as a really good review for us for the concept of present value. So because generally this is going to be covered in chapter 14, which would be non-current liabilities in Wiley, but the concepts are very applicable to us here. Okay, so now this is the cash. These are the cash payments. Now, these payments are being made in the future, right? This is not the amount over here today. So what I have to do is I have to bring these future dollars back to today. So how do I go through and do that? Well, for the principal, right, what we're going to go ahead and use is we're going to go ahead and use the present value of $1. And if this is completely foreign to you, I will put links in the bottom of the YouTube video, which will go through and show you where you can watch my shortened series videos on bonds. When we go to the present value tables for a lump sum, I'm going to go ahead and use the present value of $1. I need to know 2 things. How many times is interest being paid? Interest is being paid annually, 5 years, and the market rate of interest, which is 10%. So over here, present value of $1, 5 periods at 10%. Is 0.62092. So I'm going to take this over here. Present value of $1, 0.62092. Okay. So the present value of this amount is $5,588,280. What exactly does this mean? Well, if I go through and take, let me just make sure I got the right one here. Present value of $1, 0.6, perfect. Okay. So if I were to invest, so this is year 1, year 2, year 3, year 4, and year 5, if I were to invest $5,588,280 today at 10% interest, right? This would generate over here $558,828. If I reinvest that interest, right? This would give me an ending balance of $6,147,108. Okay, that ending becomes my beginning for the following year. If I go through and kind of repeat this, what's going to ultimately happen is by the end of that 5th year, we're getting very close to $9 million, right? So this is what we're talking about in terms of present valuing. If we have a future amount that's going to be paid, say 5 years from now, what amount today at that market rate of interest would we have to go through and invest so that this is going to be equal to the 9 million at the end of the 5 years? So this is kind of the whole part in terms of present value. And again, if this is something you haven't seen in a while or need a review, I'm going to go ahead and basically share with you the shortened series videos for bonds. Okay, so that's the principal amount right now. So, but what about the interest payments? Okay, so with this, we could go and say, well, present value of $1, 1 period at 10%, 2 periods at 10%, but that's way too much work. So instead, what we're going to use, this is present value of $1. This is, let's write this out. This is 5 periods at 10%. So over here for the interest, I'm going to be making, I'll take one of the payments. This is going to be present value of an ordinary annuity of $1. Remember, it's an annuity. It has to be the same amount every single year. Present value of an ordinary annuity of $1, 5 periods at 10%. So when I come over here to present value of an ordinary annuity of $1, this is going to be 3.79079. Okay. All right, so I've got this one right over here. Okay, so I'm going to take the 720,000, multiply it by 3.79079, and that present value over here is 2,729,369. So if I'm issuing this bond, right, the amount of cash that I'm going to be receiving is going to be 5,588,280, which is the present value of the principal, plus the present value of the interest over here, which is 2,729,369. Notice on this part over here that this is going to be less than the face value. Bonds payable is always going to be at the face value, which in this case over here is going to be 9 million. So for us, right, what's going to be the difference on 1/1/25 when this bond is going to be issued? So we call a discount on bonds payable. Okay, so what exactly, and it's basically going to be the difference between these two right here, or this 682,351. And just to finish ourselves off, this is going to record issuance of bond. And just remember, this is the debit and this is the credit. Over here, right, why am I debiting cash? Well, if we remember from our T theory of accounting, I'm not going to sing the song. Maybe I will just for fun, but I'm going to try to avoid that with you right now. So over here, we've got our assets equals liabilities plus owner's equity, or AELOE, AE, I did it. So we've got our assets equals liabilities plus owner's equity, ERDC. Okay, so cash is an asset. When we issue a bond, we're going to be receiving cash. So we're going to show that increase to cash with a debit. Bonds payable is a liability. We have to pay it back. Liabilities are increased with credits. This discount on bonds payable is a contra liability account. And what we're going to do is we're going to go ahead and amortize that discount on bonds payable to interest expense during the term of the bond. And we'll see how we do that. And the way we're going to do that is with the effective interest method. So what is my bond, even though it's not asking me for this, what is the bond, what is the presentation for bonds payable on 1/1/25? Well, my balance sheet presentation, where do bonds payable go? Well, if it's a current liability, it has to be, is it something I have to get paid, has to be paid in the current year? So generally what we're going to say, this is going to be a non-current liability. We're going to have bonds payable less discount on bonds payable is going to be bonds payable net. Now, as I'm writing this, I'm kind of making here what I would call an academic assumption. And Bennett, what do you mean by that? Well, technically, the interest, basically there's an interest payment that's going to be due within a year. So what you would have to call that is you would have to have a current liability for the amount of the interest that's going to be paid in the current year, but we're not going to do that. Right? We're just going to call it all non-current. So just kind of work with me here on this. Okay. So on 1/1/25, bonds payable is always going to be shown at the full amount. The discount on bonds payable over here is going to be 682,351. My bonds payable net is going to be 8,317,649. Now, with this part over here, and again, if this is new, please go back and watch the other videos that I have on this topic. So what is going to be my goal as I look at these different things? Well, my discount on bond payable, right? Why is it negative? It's a contra liability account. It reduces the carrying value of the liability. My discount on bonds payable right now is 682,351. What I ultimately want to see happen to this by the time that the bond, so this is 1/1/25. What I'm going to ultimately want to go through and see is that by 12/31/29, when this bond is going to be fully paid, this needs to go down to 0. Why does it need to go down to 0? Because at that time, I'm going to have to repay back the 900,000. So every time we pay interest, we're going to be going through and basically crediting the discount on bonds payable. Let's go through and see how we make that happen. So this is going to be our entry on 1/1/25. When I go over here, and I'm going to start now going through and what happens on 12/31/25. Well, on 12/31/25, what's going to happen? Well, I know that I'm going to have to be crediting cash. And every single year, I'm going to have to go through and credit cash for $720,000. So I know I'm going to have to credit cash for $720,000. I also know, because I borrow this money, I'm also going to basically have to go through here and record interest expense. I also know as well that what do I need this discount on bonds payable to go to? I need the balance to go to 0 ultimately. So what I'm going to have to do is the discount on bonds payable. Now, when you took financial accounting, there are 2 ways you can do it, right? There's a straight line method of bond interest amortization, where you take the 682,351, you divide it by 5, and you have the same journal entry every single year. That's how I generally teach the lower division financial accounting, but we're an intermediate, so we get to spice it up. So right over here, this is to record interest expense. And so now what I need to go through and do is to use the effective interest method of bond amortization to figure out the amount I'm going to be recording basically for interest expense, as well as the amount of the discount amortization. So let's go ahead and build ourselves a table. Let's build a snowman. Okay, so for 12/31/25, my carrying value of the bond is going to be what? Well, it's basically going to start out over here at $8,317,649. That's my beginning carrying value. To determine the amount of the interest expense, what I'm going to go ahead and do is I'm going to take my market interest rate. What was my market interest rate? It was 0.1. So my interest expense is going to be $8,317,649 times 1%, or $831,765. So my interest expense is right over here. Now, at this point in time, I could just say, oh, this is like let's compare these two, but we don't really want to go through and do that. So over here, and I'm going to change something up real quickly. So we're going to say over here, bond payable. This is at 9 million, and you'll see why I'm doing this for a second in a moment. So over here, I've got my bond payable less my discount. My discount over here is at 682, so my carrying value is 8,317,649. My interest expense here is going to be 831,765. How did I get the interest rate? How did I get the interest expense? I'm going to take the carrying value, multiply it by the market rate of interest. I'm going to get over here, I'm going to get the amount of interest expense. What I'm then going to do over here is I'm going to say, okay, what was my interest payment? Right, the cash payment. My cash payment is going to be $720,000. So what is going to be over here? What is going to be the difference? The difference is going to be my discount amortization. Okay. So the amortization of my discount right over here is going to be $111,765. Okay. Right. So $111,765. Now, when I look at this, what is my ending carrying value of the bond? Okay, so over here, what I'm going to do is I'm going to take over here AA. And I'm going to go ahead and add that discount amortization. So over here, my beginning carrying, so my ending carrying value, this over here is going to be 8,317,649. I go ahead and add this part over here, and now it's going to be 8,429,414. Let's take a moment and just kind of see where we're getting our numbers from. Okay. So I'm asked to go through and to do the balance sheet presentation for this for multiple periods of 12/31/25, 12/31/26, 12/31/27, 12/31/28, and then 12/31/29. And as I look at this discount on bonds payable coming right up here, okay, so this was my balance on 1/1/25. When I go through and do my first amortization, right, I'm going to go ahead and credit this over here for 111,765. And so again, remember, what is our goal for this? We want this to be 0. So I'm going to be crediting the discount, okay, over here. So my ending discount on bonds payable is 570,586. If I take this over here, my discount on bonds payable as of 5/31/25, my bonds payable has not changed. So my ending carrying value is what I have right over here. Okay, let's just kind of go ahead and breathe this in just for a moment. So when we go through and are going through and recording interest expense, right, what do we have to do? Well, we're not only just paying the cash, but we also have to go through and amortize this discount on bonds payable. Because in reality, are we really paying 8% interest? No, we're not paying 8% interest. In reality, we're really paying 10% interest, because that was the market rate. You know, when the bond was sold, no one wanted it unless I discounted it. So now I'm paying a higher amount of interest because I'm basically paying 8%, but it's really more like 10 because that's what the bond was priced at. So coming over here, right? So when I record, I know I'm going to have to pay out cash, right? Every single time I'm going to be paying out cash of 720. But what I need to go through and figure out is how much am I amortizing this discount by? To figure out the amount of interest expense, I'm going to take the carrying value of the bond times the market interest rate. This is going to give me my interest expense, less the amount of the payment is going to come over here to give me my discount amortization. And this is over here is going to be my ending carrying value. So that's year 1. Let's do year 2. So 12/31/26, bond payable hasn't changed. My discount balance is right now going to be 570,586. Okay. So right over here, my carrying value is 8,429,414. My market interest rate is 1%. So my interest expense is going to be 842,941. My payment has not changed, right? So over here, now let's make this go up a little bit higher. Okay. So over here, so 12/31/26, 12/31/26. $12/31/28, and then we've got 12/31/29. So on each one of these dates, right, just for the interest, right, we're not going through and talking about anything else, but just in terms of going through for the interest, is that I'm always going to be going through and paying out 720,000, right? I'm always going to be making a cash payment of 720,000. So this part of it here is not going to be going through and changing. Okay. So, but now over here, we just figured out, oh, my interest expense over here is going to be 842,941. Okay. I compare this to the amount of cash that I paid, which is not going to change. And then this over here is going to give me my discount amortization. So my ending carrying value is going to be what? Well, it's going to be my beginning plus the amount of the discount amortization. So if I look at this over here and I got 9 million, what is our new discount? Well, right over here on 12/31/26, I just went through and amortized this by 122,941. So my new ending balance over here for my discount on bonds payable is going to be 570,586 minus 122,941, or 447,645. So this is my new balance. So right over here. And there we go. Okay. So my new ending carrying value is 8,552,355. If you're doing this for a class, you're probably not going to need to show this amount of work. I just do it because that's who I am and that's how I roll. But if you're doing this in a classroom setting, you're not going to have to show this much work. I just really want you to take that pencil and paper, get it out, start busting it out. We're not doing painting with Bob Ross. We're doing accounting with the accounting professor. And so we got to get out that pencil and paper and we got to start writing the stuff out because that's really the only way you're going to get to understand it. So over here, 12/31/27. Bond payable hasn't changed. My discount on bonds payable is now 447,645. So my new carrying value is going to be 8,552,355. Market interest rate still going to be over here at 10%, right? That's never going to change. Once we have basically a market rate, that basically we're never going to basically go off of that, even if the rates change. So my interest expense now is going to be 855,236. My payment is still going to be 720,000. My discount is going to be the difference between these two, and my ending carrying value is going to be 8,687,591. Now remember, we want this amount eventually to get up to 9 million. Okay, so let's kind of take a look at what we just did. So over here, we now have 12/31/27. We went through and amortized our discount by 135,236. So my ending balance over here on my discount on bonds payable is going to be 312,409. So let's go ahead and do our journal entry. So 12/31/26, I just got to clean this up a bit. There we go. So over here for 12/31/27, I've got 855,236, and then over here I've got 135,236. So in terms of our balance sheet as of 12/31/27, I have 9 million. My discount on bonds payable, right, has an ending balance of 312,409. And so now we're at 8,687,591. So let's go ahead and go to our next year. So 12/31/28 bond payable. My discount is getting smaller and smaller because we're getting closer to that maturity date. My carrying value, 8,687,591. Multiply this by the 10%. Compare that over here to the 720 payment. My discount amortization for this year is 148,759. So my ending carrying value is going to be 8,836,350. I add in right over here and coming over here to 148,759. This is going to be 12/31/28. So my new ending balance over here for my discount on bonds payable is going to be 163,650. So this part over here, let's go ahead and put in our numbers. So my interest expense was 868,759. My discount on bonds payable, basically my amortization was 148,759. So over here, I got 9 million. Over here, I'm now going to be subtracting out 163,650. And so my new ending balance is 8,836,750, right? This is what it is right over here. Okay. Now I get to my final year. All right, let's go ahead and take a look at that. So 9 million. My discount my unamortized discount is 163,950. So this is 8,836,350. Multiply this by 10%. Go over here to 720. So the amount of the discount I'm amortizing is 163,635. Okay, so I'm going to go ahead and amortize 163,635 is the amount I'm amortizing. Okay, so this is 12/31/29. Now, if you look at this and I subtract this through, we now have a difference of, say, $15. So what I'm going to go ahead and do is I'll just say, well, I need this to be 0, right? So I'll just call this 163,650. Okay. So we'll go 163,650. So my ending carrying value of the bond is going to be right over here or at 9 million. So I did the little $15 fudge and we're all good to go. So over here for my bond payable, right on 12/31/29, once I've gone through and done this, it now has an ending balance, or the amortization is now 0. And so I've gotten to where I want to be. So this is going to be fully amortized through over here on 12/31/29. I've got this over here at 883, 635, and then 163, 650. I'm also going to have to change this amount over here to 883, 650, just so that my total debits equal my total credit. So I just fudged up the interest expense and the amortization to make it basically balance through. So as we go through and look at this, and again, if you're taking one of my classes, I'm not going to make you go through and do 5 years of effective interest amortization, especially without Excel, because that's just an absolute nightmare. Maybe 6 years. I'm just kidding. But when we're going through and looking at this, this is what we really have to kind of, we want to go through and consider is that, what's happening here? Well, this discount is really kind of going through and reflecting, well, the interest rate, the stated interest rate was at 8%. Because the market was at 10%, no one wants my bond. So the bond will naturally go through and sell at a discount, right? But then what happens with that discount on bonds payable is it's going to end up basically being amortized to interest expense, meaning my interest expense is going to be higher to reflect that higher rate of interest that I discounted this with. So the cash payments never change. It's just we have this discount on bonds payable. Remember, the discount has to go to 0. So this is why we're going through and pulling the amortization through on this. So again, this is, if you're taking one of my classes, this is not going to be something that you're going to have to this is just to give you an introduction to how effective interest method works for interest amortization and a kind of a present value refresher. You're going to want to get very familiar with these two tables over here for valuing bonds. I cannot tell you how important these are, but that's really the first example over here in terms of present valuing bonds with the effective interest method. And this is just part 1 of the video. So we're going to have even more fun when we get to parts 2 and 3. But I want to thank you for joining me here today. Please don't forget to like and subscribe. If you have questions, please feel free to email me at 1812cpa@gmail.com, or also go ahead and leave a comment in the YouTube. Again, I try to get back to, I will try to get back to you as quickly as I can. But obviously, as I teach full-time over here at Irvine Valley College, which is, I think we were ranked in August 2022, or this year, we were ranked as one of the top 10 community colleges in the country, so which is pretty sweet. So love to see you in a class. And I look forward to seeing you on the next video. Have a great rest of your day.